Give, and it will be given to you. A good measure, pressed down, shaken together, and running over, will be poured into your lap. For the measure you use, it will be measured to you. And the version that I often share is a paraphrase from the Message by Eugene Peterson. Same verse, Luke 6:38. Give away your life. You'll find life given back, but not merely given back with bonus and blessing. Giving, not getting, is the way. Generosity begets generosity. Again, give away your life. You'll find life given back, but not merely given back with bonus and blessing. Giving, not getting, is the way. Generosity begets generosity. As we reflect on these scriptures in these seemingly perilous and difficult times, we know that we are anchored in the grace of God. We know that we are anchored with our gratitude through the grace of God, and that allows us to overflow with our generosity. And so let us join our hearts together in prayer. Eternal God, we thank you as we gather this day to look back, to look forward, and to celebrate the ways in which we are the hands and the feet and the body of Christ together. We celebrate and give thanks for your amazing grace that we experience in the overflow of gratitude and generosity that you've poured into our lives. We thank and praise you for inspiring the work of NCTC and the foundation and all of our partners. We thank and praise you for all who trust and rely on you as the source and the joy in all of our lives together. In the midst of all and even of the most challenging circumstances, we come before you seeking the signs of the times, rejoicing and sharing our sorrows together, but most of all, rejoicing in the impact of our collective witness, our stories about the impact of the amazing generosity that is flowing in and amongst our community of faith. Lord God, we give you thanks, we give you praise, we give you all the honor and all the glory on this day as we welcome all into this community that's seeking your wisdom and your way forward together. In Jesus' name we pray, amen. Thank you for the privilege of sharing.
Thank you so much, Rose, for the good word today. We appreciate all that you do for our church community, and I know that the congregations that you work with are also very grateful for you. So thank you so much for sharing that today. Next up is James Carey to provide a market update. James is the Director of Investments and Portfolio Management Services for New Covenant Trust Company, and he contributes to all aspects of the investment committee's research, monitoring, and due diligence functions. James also performs macroeconomic analysis and multi-asset strategy positioning. James is a CFA charter holder and a certified financial planner professional. James, it's all yours.
Well, thank you, Angela, and thank you, Rose, so much for that prayer. Thank you to our audience. Thank you to everyone for your time and your interest in this presentation. We are going to have to move decently fast through this material, but please know we are so happy and really welcome any follow-up questions. Brad Masters at the end will be providing some contact information for you to reach out to our team, to your ministry relations officer. And we are just so happy to provide more time for you and your specific situation. So please just reach out. But we'll be going through this just in a 1-hour webinar today. We will do a market update. We'll look at 2021 and ahead to 2022. And as we just set the context a little bit for 2021 on the next slide, we want to just see where we are as we consider where we're headed. So, you know, in 2021, we did see very strong market performance. The S&P 500 was up over 28%. That's following a over 16% return in 2020 and an over 28% return in 2019. And one of the questions that we got sometimes through the pandemic is everything feels so sometimes very negative. We've been going through this pandemic. It's been very disruptive. But the economy, the market, many different risk assets, their prices have just gone up and up. And what sort of explains that? Well, there are some explanations for that. You'll see here probably one of the biggest ones has been very stimulative and accommodative monetary and fiscal policy. So the monetary policy has been very accommodative, zero interest rates, very low interest rates, other stimulus associated with the monetary policy of the Federal Reserve. And that has helped rise asset prices as we recovered from the pandemic. At the same time, corporate earnings and many companies, their balance sheets and their bottom lines have been decently strong. Demand has been very high, and many companies through 2021 have actually had very good results and great years for their businesses. And so companies have been doing well, and that has resulted in rising stock prices. We also, by the end of 2021, have a pretty healthy underlying economy. So unemployment is at 3.9% out of December. That has recovered to nearly full employment. GDP numbers are back to about the trend that we were on pre-pandemic. So many of these classical examples of just the underlying economy do point towards a decently healthy underlying economy. So all this has helped explain strong market performance out of the pandemic. And on the next slide, we just see that a little bit visually. 2021 was a strong year. We entered the S&P 500 a little bit under 3,800 and ended the year at nearly 4,800. The next slide, though, is really the context that we like to look at. So this is the 30-year chart on the S&P 500, and we do like to just set this context of how it has been for long-term investors over this time period. You will see that there are a number of recessions on this chart. There was the 2000, the 90s technology recession. There's the Great Recession here. You see on the far right, the COVID pandemic recession. But markets over this 30-year period going from below 500 now to ending 2021 above 4,700. This is the context that we like to set in terms of being a long-term investor, and we'll get to that a little bit through this presentation. One thing to note, though, on this chart, we do want to set the context just for where we are in the market cycle at this time. You will see on the right, after we recovered from the worst of the COVID drawdown in 2020, prices really have rather rapidly and rather quickly appreciated. So you'll see almost a vertical-like rally in stock prices from here. And sometimes that is something just to be aware of. When something goes that far up that fast in terms of a stock price or an asset price, it is something to at least be aware of. But again, we do have some explanations for this sort of market activity versus, a tech bubble or something like that. So on the next slide, we do see some of that. This is corporate earnings by calendar year. And really on the right side, you'll see calendar year 2021. The dark blue line is where we expected corporate earnings would be heading into the year. And then the blue and white line is where corporate earnings actually ended up for the year. So this is really just showing that corporate earnings were much better than expected. Companies actually navigated the pandemic, navigated the supply chain, navigated inflation much better than expected, at least through the first few quarters of 2021. And when you have better than expected earnings, that does result in prices going up. That was one reason why we saw appreciation in the market. Companies really were doing well. On the next slide, we also see the recovery in the underlying economy in terms of the labor market. So after reaching nearly a 15% unemployment rate early in the pandemic, those early days of March and April of 2020, the labor market really has recovered rather rapidly, now back down to what many consider close to or near full employment at under 4% unemployment. So the labor market and the underlying economy in general has remained healthy. Demand and the consumer remains rather healthy. And so these are all positive and healthy signs for the economy that have helped put upward pressure on stock prices. As we look ahead, though, on the next slide, there are some real challenges for 2022. These are number one, Omicron and COVID-19. Really, this is a big one as we look ahead to 2022, primarily because uncertainty really is elevated. This is just a virus and a pandemic that has continuously humbled us. We think we understand, we think we know what's going on, but then there's something new. There's something that is that we don't know the answer to, and things like this. And so as uncertainty is elevated, that is something that gets discounted in especially stock market prices. So uncertainty is elevated. That's a headwind for the market moving forward. Another big one is inflation, which is high, and we'll look at some of that in a few slides. And inflation is especially important to the extent that it is driving the Federal Reserve's monetary policy. We talked about how interest rates and monetary stimulus were a big reason for some of the rapid appreciation in stock market prices in 2020 and 2021. Well, interest rates are sure to be on their way up, and stimulus is being tapered down. And so these things that really supported strong stock market growth in previous years are being taken away, and that is a headwind as well for stocks. At the same time, the underlying economy does remain relatively healthy, although it is moderately slowing. As we look at the first quarter of 2022, it does appear that we will have some real effects of the Omicron variant of COVID-19. We also continue to have shortages in many areas of the economy, including supplies, materials, and labor, which is also likely to moderately slow from where the economy could be. And again, valuations do remain high. So anytime that stock prices are relatively high in terms of valuations, it really doesn't take much bad news to cause some volatility from those prices. To keep prices that high and elevated, you need more and more good news. And so to the extent you get moderately negative news or worse than expected news, that can cause market volatility at these levels. So on the next slide, we'll just go through some of these risks and charts illustrating these. As we look at valuations, you do see that on the price to earnings ratio, the S&P 500 is a little bit under 19 right now. That's above the 10-year average of around 17, and even this 10-year is a little bit elevated historically. So we do see rather high valuations. We especially saw that on the 30-year chart, just how far stock prices have come. That is part of the environment that we're in, that prices are already decently high. And so that will contribute to it takes less to cause some volatility from here. On the next slide as well, we do see that the corporate earnings picture is moderately weakening. So if you look over to the right, you will see especially 2021 quarters, anytime this green bar is above the red bar, that means that more companies are beating expectations, are doing better than expected as they look at their quarterly corporate performance. But on the far right, for the first time in the fourth quarter of 2021, we're seeing more companies doing worse than expected. And so we are beginning to see the inflationary pressures, the difficulties in hiring and staffing really beginning, I think, to affect some of these companies' bottom lines. That was one thing that really helped stock prices in 2021, but that strength may be weakening from here moving forward. So that is also something that we're keeping an eye on. The next slide, we will see inflation. So a really big one here. This is the Consumer Price Index, and you will see that our most recent inflation number was the highest level in quite some time, and inflation is elevated at 7%. There's a number of reasons why we believe that inflation is it's not our base case that inflation is going to reach, hyperinflation or 15 or 20% inflation necessarily, or that it will remain really, really elevated for a long period of time, but it is certainly affecting the economy. I think it's affecting everybody at this point in different ways. And most of all, the Federal Reserve has really signaled an aggressiveness in how they're going to approach inflation by tightening monetary policy, and especially most of all in the very immediate term, that tightening monetary policy is a big driver affecting markets and stock prices from here. A couple more slides on inflation. The next one is just going to show one of the contributors to inflation has been a very, very tight labor market. Wages have been increasing quite a bit, which is good news for workers. But we do see a record number of job openings, nearly 11 million job openings in the economy. We're also seeing record numbers of quits or resignations in the economy. So workers really are, through the pandemic and through many different ways, reassessing um, where they want to work. There's been a surge in entrepreneurship and small business development and things like this. So it's a difficult hiring environment for companies that's been somewhat inflationary. And we see a very tight labor market contributing to some of the inflationary pressures as well as the supply chain issues. The next slide supports a little bit some of our view that some of the inflation may be likely to moderate in the medium term. So this chart just shows contributions to the consumer price index. Over on the far right, you'll see the dark blue line is services inflation. The lighter blue line is goods inflation. So this has really been the one thing you'll see that jumps out from the historical data as really accelerating post-pandemic. So this is when everyone were stuck at home and there's been many purchases of furniture, appliances, these goods types of services. And that's been especially exacerbated by the supply chain disruptions that we saw as the global economy, the global supply chain really had difficulty navigating COVID, as there were disruptions in, the factories being able to build and different materials being able to get there on time. We do believe we have begun to see real signals that the demand for goods is declining from where it was previously. And this is also something that as the supply chain begins to unwind, it should be a positive for moderating inflation moving forward, especially that this goods inflation moderates. On the next slide as well, an indicator that we closely watch, this is the break-even inflation rate. So this is essentially what Wall Street is sort of pricing in inflation insurance to be at. And you will see that expectations for 10 years from now, on average over 10 years, around a 2.5% inflation level. So that is a moderately increased inflation level. That, for a while, people were putting in 2% as assumed inflation. It really is more likely that should be closer to 2.5 or 3% at this time, but it is a far way from 15 or 20% inflation. So this is really where institutional investors, where Wall Street is sort of pricing in, inflation expectations in the medium to long term, and that is something that we closely watch for signals that observers and traders are really expecting inflation maybe to run away. So we do expect inflation primarily. Our base case is that it will moderate from here at around 7% this month and next month inflation read, but that it is likely to some elements of inflation are likely to remain sticky, and inflation is likely to be at least moderately elevated. If you're assuming 2% inflation, that may be too low moving forward. The next slide just also indicates the biggest, I think, immediate term effects for the markets, which is rising interest rate, tightening monetary policy. So this is the 2-year US Treasury, often viewed as something of a proxy for interest rate expectations. And you'll see that since September, when it was around 0.2%, this number really accelerated. It's now accelerated almost 100 basis points, 1%, to 1.2% on the 2-year US Treasury. So the bond market is definitely expecting interest rates to increase. That's already being priced in at around 1%, consistent with expectations that interest rates will increase. There will be as many as 4 or probably at least 4 interest rate hikes in 2022. The next slide, I think we're beginning to just summarize a little bit our expectations. So, in summary, as we look at 2022, following 4 out of 5 years with 15% returns on the market, 2022 is likely to present a much more difficult environment for returns, especially double-digit returns, than the recent past, as inflation remains stubbornly elevated and is exacerbated by ongoing disruptions from the pandemic and the supply chain. The Federal Reserve has signaled an intent to act aggressively to wind down their monetary stimulus and to address inflation. While the wind down of fiscal and monetary stimulus will hit certain sectors, so especially speculative growth IPOs, certain really early stage companies and other speculative assets have been hit especially hard. The normalization of monetary policy really is consistent with a healthy underlying economy. However, between the tightening monetary policy, already high valuations, and a still uncertain pandemic, investors really should not be surprised by some market volatility in 2022. We've already experienced some of that already. It really is more important than ever to carefully look at and calibrate your time horizon, your goals, and your risk tolerance to that level of equity exposure that you have, to be wise with cash management and to remain broadly diversified across size, style, and industry of the market. It is our view that disciplined long-term investors, one of the biggest ways you can contribute to success over long periods of time is not making abrupt decisions in times of volatility, fear, or exuberance. We do, in our view, we are sort of our human nature wired to sometimes really do the wrong things at exactly the wrong times. As markets really go up and everyone's really excited about the market, you know, what we want to do is buy sometimes, and when everyone's really fearful, sometimes what we want to do is sell. But it really is important, especially in this environment, to have a plan, to have a long-term plan, to really remain disciplined within that plan, because there will be ups and downs through, you know, if you have a 7 to 10 plus year investment horizon. And so sticking to that plan is important, especially in these volatile years. So on the next slide, we just conclude with a couple of things that we're doing in our portfolios and advising our clients to consider. First and foremost, really maintaining a healthy cash reserve of between 6 and 12 months of spending. In our view, maintaining that cash reserve allows for your near-term spending to be kept away from the market volatility, reducing your risk of needing to sell stocks following a correction or in times of volatility. Remaining broadly diversified. You know, the high growth technology stocks have really been the stars of the market for years in a row, but it's really important that you remain diversified and balanced between sectors such as banks, healthcare, real estate, between growth and value, large, mid, and small cap stocks, even geographically, because the US valuations are relatively high compared with the rest of the world. So certain sectors will do better in inflationary and rising rate environments. Some will do much worse. And so it is our view that we really need to remain balanced and diversified across those sectors. Considering limiting the duration on bonds, so with interest rates expected to rise, we've reduced the duration on our bond portfolios. So, you know, instead of a 10-year bond, you know, a 4-year bond would be a lower duration. Existing bonds see their prices go down as rates go up. And so reducing duration does reduce your interest rate risk. And also shortening duration may allow you to reinvest at the higher rates sooner as those shorter bonds mature. Finally, long-term investors really should maintain a long-term view. This is probably our biggest one. For investors with time horizons of 7 to 10 plus years, corrections, recessions, near-term volatility will be a regular occurrence. There will almost always be concerning headlines, near-term headlines in the business news and in the news. Avoiding making rash decisions during times of volatility has been shown empirically, really time and time again, to be a big contributor to optimal outcomes over long periods of time. Markets have rewarded patient, long-term investors with positive returns over time. And in conclusion, just this last slide, I think really shows this. This is from one of our fund partners, Dimensional Fund Advisors, showing the growth of $1 since 1926. And this really is the context. I mean, many of our churches have been around this long. Many of our investors have been around this long. You know, $1, and if you look at the US large cap, that's just the S&P 500 over on the right, the gray. $1 in 1926 has grown to $9,237. That's been through the Great Depression, the Great Recession, wars, many issues. You know, markets really have rewarded patient, long-term investors. And this is the context that many of our investors are in with long-term types of goals. And so we do encourage this context when the near term, when the daily headlines are front and center. You know, this sort of zooming out, we believe is really helpful and healthy for investors to maintain. So finally, on the last slide, we just want to say thank you. Thank you to all of our supporters. Thank you to all of our clients. Thank you to anyone that's given us an opportunity to provide any advice or service that we can to you. It really is our mission, our great honor to serve you all. And as we introduce our next speaker, you know, we'll just say many of our investors had a great year in 2021, but it's really not just the dollars and cents the only thing that we think about necessarily. Many of our, especially socially responsible investors, have contributed to a historic year in socially responsible values-based investing, shareholder engagement, in how we vote proxies, how we engage with companies, and impact investing, making positive social or environmental impact with those investments. So our next speaker is James Malone, and we're just so grateful that James is sharing his time with us. I hope the whole church will join me in just thanking James for his time in this, just to talk a little bit about the other side of what we do, especially for our socially responsible investors. 2020, 2021, there's never been more interest. There's never been more engagement or impact in what has gone on in the whole world, the whole faith community through the Interfaith Center on Corporate Responsibility than what has gone on in the past couple of years. So we really wanted to lift that up as well as we looked back on 2021. And so Angela, I'll turn it back over to you, but I'm looking forward to everyone's questions, and just thank you again for being here.
Great. Thanks so much, James. It was very informative, and we really appreciate the diligence and the thoroughness of your presentation. Very helpful. And I think good to have that long-term perspective and not think that double-digit returns are here forever. So thank you so much for that. I do want to remind folks about questions. If you do have a question, you can put that either in the Q&A function or in the chat box, and we will respond to those questions at the end of the planned presentation. So look forward to those questions. So our second James of the day is up next, James Malone. James Malone is the Chief Financial and Diversity Officer for the Community Capital Management, CCM. He's a member of CCM's Board of Directors, a Management Committee, Diversity, Equity, and Inclusion Committee, Investment Committee. In addition to his many other roles and responsibilities, James maintains a focus on helping religious organizations and faith-based investors at CCM. James is a CFA charter holder and a member of the CFA Institute and the CFA Society of South Florida. James, it is such a privilege to have you with us today. We are really excited to learn more about the wonderful work of CCM, and I'll turn it to you.
Thank you so much. Really appreciate that, Angela. And thank you for the invitation and the opportunity to do this. What I really like is the fact that we're having the James and James show today, the J&J. So I like that, and I vote CFA, so couldn't ask for anything better. But thank you for inviting me. I wanted to, I am going to talk about impact, but before I do that, just wanted to give a little bit about myself so that you could sort of get the lens from which I come and my background, why for me this is very important. And I say that because I am the CFO for the firm, but one of the things I earlier on is that I mentioned that I have to interact with our clients. I have to interact, and the community I wanted to interact with most was our faith-based clients, because faith is important to me. Impact investing is important to me. Finance and my background, my previous background as an accountant, a CPA, all of that coming together is just this sort of weird mix, but all of that is very important to me, and there's a reason why. And one of the reasons why I grew up in a home at a very young age. It became a single mother home when my father and mother separated, and really was just my mother that was raising myself and my sister. And faith was very, very important. I mean, that's what took us through a lot of the difficult times. Faith was key. And I didn't know about it and think about it as impact investing back then, but it's important for you to know that I realized that I am where I am today because of impact investing. So I'm very passionate about it. You know, I talked to James before, and I could go on and on about it because of how passionate I am. And the reason for that is at a very young age, I was able to see my mom struggling with a business and trying to make things work. And I remember vividly one day going down to our town, and I grew up in the island of Antigua in the Caribbean. And I know you think beach, sand, and it's beautiful, but you know, sometimes it can be difficult down there. And I remember my mom going to town and getting this small loan. It was about $1,000 US, translated a couple thousand Eastern Caribbean dollars. And she was able to take that and expand her store, or sort of like a little restaurant, but a lunch shop really. She was providing lunch to the workers who were on the boats in the community where I grew up. And she was able to expand that and send us to a good, decent Christian private school. And from there, it just expanded and was able to send it off to college. And I am where I am today. But when I learned about the loan, it was a micro loan through a Canadian program. And today I look back and say that was impact investing, because it was someone funding it, saying give these loans to small businesses in the island so that they can expand. And my mom was able to do that and expand and provide the kind of income that she needed for us to get the education we got and the life that we now have. So I am just sold out on impact investing and faith as well. So I'm going to jump in and try to speed through this to give us a chance to ask questions. Going to the next slide, the next one. I wanted to give sort of a brief history, and I'm not going to spend a lot of time here. The main takeaway here is that faith-based organizations and institutions have been at the tip of the spear of sustainably investing, socially responsibly investing, you want impact investing forever, right? I know lately we've never seen the interest as we've seen now, and there's a lot of talk about it. But when you think way back to the 1700s, where you had someone like John Wesley leading the way in avoiding investing in businesses that were tied to war, slavery, tobacco, and gambling. And it was said that John Wesley noted that the use of money was the second most important subject of the New Testament teaching. And using money in that way to say, hey, this is not right. And investing with that kind of purpose was way back there. Then we have the Quakers, again, around the same time, that led the way in for the abolition of slavery, with the effort of what was called the Free Produce Society, that boycotted goods and produced by slave labor, goods produced by slave labor. And I'm very familiar with that. I grew up in the islands and I saw a lot the old sugar mills there. And sugar was a big part where the sugar was produced by the British West Indies, and they basically said, look, we're boycotting this, and we don't want this to happen, and to help to have slavery abolished. So then you fast forward years, centuries later, and you have the first funds being established in 1928. You have first mutual fund in 1970s. And even as we are today, you have so many different denominations coming out with policies and procedures and investing goals that's really targeted to say, hey, look, we want our dollars to speak for us in terms of just economic justice, to help those who are in need, and to make sure that the environment is clean. So, and in the 1980s, there's been significant work by a lot of, I think, Catholic organizations like the Women Religious, leading the way with the anti-apartheid movement and other movements, saying, hey, let's take our investment dollars and making sure that they're speaking for us in line with our values. Next slide. And just before I talk about that, and that sort of fits in very well with Presbyterian faith as well, where you have the social witness policies that has that investment component as well, in terms of avoiding certain things and proactively looking to invest in community development and community investing. James mentioned this, I believe it was James or Angela, someone mentioned that, ESG and impact investing has grown significantly over the years. And as of, last year, it was estimated that about $17 trillion of the 51 trillion of investable dollars around the world was invested with a lens of sustainable investing. That is a third of the assets being managed. And we've seen that growth significantly in the last decade or so. And you can see from the chart here where shareholder advocacy has increased. A lot of firms now, major firms, BlackRock, Morgan Stanley, all these major firms are incorporating ESG. Many asset managers are saying ESG has to be a key component. And that's driven a lot by the investors, many of whom are faith-based investors. So we've seen in the last year or so a 40-something% increase in assets invested with that lens. The next slide. So how does community capital management fit into this? Who are we and what is it that we do in the space of socially responsible or impact investing? We consider ourselves as impact investment managers. And we manage about $4 billion in assets under management. And these assets are managed in a way to positively impact communities all across the United States. Our flagship strategy is a fixed income strategy, and I'll talk about that a little bit more. And that's our flagship strategy. Fixed income strategies on the public end. But what I want to mention here as a takeaway is that we have been doing this for over 22 years. And 22 years ago, you felt like you were out there. There were several, faith-based clients, some foundations, some other ones saying this is important, but you didn't hear the drumbeat. You didn't see all the articles every day in the Wall Street Journal. You were sort of out there trying to say, this is important. Community investing is important. But so we've been doing it for 22 years. And many of our clients from banks, foundations, faith-based organizations have helped us to shape the firm that we have today and the impact strategy that we have to offer our clients today. The next slide sort of talks about our core fixed income impact strategy. And this is a strategy that New Covenant Trust has looked at and has as part of its portfolio, and has really, seen the importance of helping to align investors' investments with their faith and their values. So what is this core strategy? So it's a core bond strategy that is in the, James talked about duration. Our strategy is an intermediate term bond strategy, but it's managed very much for to have less duration than other intermediate term bonds. So for instance, you may find intermediate term bond strategies out there with durations that are 6 or 7, longer securities, longer dated securities, whereas we try to have less of a duration, around 4. So right now our duration is less than 4. And we do that because many of our clients want us to be more conservative. We're seeking to preserve capital. We want this strategy to be the ballast in your portfolio. As James talked about, the markets and how the portfolio is positioned, I thought to myself, the work that New Covenant is doing allows us to sleep at night. And that's the same thing here. Is from a financial perspective, the way that we manage this portfolio allows our investors to know that it's more, it's conservatively managed. We're looking for risk outperformance and risk adjusted basis. And it will be when the market, the equity market, is moving in the opposite direction. When there's a significant drawdown, you expect that this strategy to be a ballast in your portfolio. So that's the financial aspect of our core bond strategy. However, the other aspect, the impact aspect that I want to talk about more today, allows us to get up in the morning and be excited about what we're investing in. And that is where we, as I said before, we're seeking to finance projects and investments that is positively impacting society across several impact themes. And we allow our investors to either geographically target or thematically target. On the next slide, we'll talk about the thematic targeting, because this is where we're able to put our faith values to work. So as a firm, we have 18 impact themes, from affordable healthcare and affordable housing, all the way to sustainable agriculture, rural community development, neighborhood revitalization, education, and childcare. And these themes, every single one of our investments must touch one or multiple of these impact themes. So think about yourself as a faith-based organization where you're saying, hey, our responsibility is to be the hands and feet of Jesus, to proclaim the gospel, not only in words, but in action. And when you think about what you have and the asset that you have to do that, you have your time, you have your talents, and you have your treasure. And as a church, for years, we've used our time and our talent. And this is where, from an investing standpoint, you're able to use your treasure to be the hands and feet of Jesus. So not only, the old paradigm, you would think about, okay, I will invest my funds and get as best a return as possible. I would avoid certain investments to make sure that they're not causing any harm in the society. But then the returns you get, I will use that and fund our church efforts. I would allow us to have the ministries that we're doing. But what about the other 90% of your portfolio sitting there, not just the income off of it, not just what you're able to spend and fund your ministries? What happens to that investment? Can that investment speak for you as well? And that's where proactive, positively screening, focused impact investing comes in, where you're able to say, you know what, as a church, as we're really focused and we see the need in our community for affordable housing, there's too much homelessness. There is still disparity within certain communities and housing and the wealth gap, and we want to make a difference there. We allow our investors to target those themes and to invest in a way that will make a difference across the board in these very areas, societal problems. I would say a quick thing there, because I realize time is going, is that what I've found with most faith-based organizations, and I'm sure this is true for New Covenant Trust and the Presbyterian faith, is that when you look at the areas of focus, there is one, addressing the income and economic inequalities and inequities that are out there. Many faiths are saying, okay, how can I invest to address that? The other thing is they're looking at, how do I invest to care for the planet? And then how do I invest for the dignity of work, to make sure that individuals are having good, decent job with decent pay and helping to deal with income inequality. And that's what I've found with many faith-based organizations. And these various themes allow you to address that. For instance, addressing income and economic inequities and the plight of the poor and the underserved. One of the main things there is affordable housing, right? And a lot of our investments will look at affordable housing as one of the themes. Because a house, a decent affordable housing and a house is not just a roof over someone's head. It's a home where kids do better in school. Families become healthier or have the opportunity to be healthier. And individuals may have a better and more decent commute to and from work. And that really changes lives. And we know that there's a significant need for that in our community right now. And the other is economic inclusion, where you allow for broad-based participation in the economy by providing access to capital to a small business owner, a minority owner who otherwise would not have gotten that access to capital. And by providing the funding there, they're able to build a business and create a life for their family. So those are areas that we see a lot of people targeting. Next slide. Here, it just says that we are able to either geographically target down to the county level. So you will make an investment and we will go out and buy bonds that will target projects or investments in a particular geography. So you may want to say, I want to impact the city of Louisville. I want to impact the counties around Louisville, or I want to impact New York or Massachusetts, wherever we're able to do that, target that way. Or we're able to also target, as I said before, thematically, whether it's education, environmental. In the last 2 years, we had two major initiatives, the Minority Cares initiatives, where we realized that, from George Floyd and the whole awareness around that it's important to reinvest back in those communities, because for years there have been significant disinvestment in minority communities, and also COVID relief investments initiative there. Move to the next slide, because I realize that time is running and I want to make sure that we have some time for questions. This just tells us in the last year, we've invested over 700 million. And you see across all the different states how much we've invested in different states that's seeking to positively impact communities there. And then the next slide. That talks about initiatives I just mentioned. But I want to skip forward to investment example. I want to just take a minute and then I'll leave it open for questions on these examples. So for example, one of the things that we're able to do in most recent years is to custom create pools that's targeting minority borrowers, or whether it's Black borrowers or other minority borrowers, or even gender lens view where women borrowers as well. And what we do here is that we're putting together a pool of mortgages. So we're going out to the capital market and say, we want these loans, and we're creating a pool, a mortgage-backed pool that's specifically targeting this particular group. And that drives capital to these borrowers, so they know that, hey, look, we can lend to these borrowers so that they can buy a home, right? And believe it or not, there's still discrimination happening out there. So when we invest with purpose to say, let's drive capital in this area, it significantly changed lives. So here is a pool of 16 borrowers, 10 of the loans in heavily minority census tract areas, and 7 of them are Black women borrowers. So, and the beauty about this is that we're able to see the homes, we get very granular detail, and we're able to see how they're able to build wealth over time, because you can see the appreciation in the home over time. And we're actually looking in at how to quantify that and provide that kind of information to our clients. But at this time, just driving capital to this space is very good. The next slide talks about an affordable housing that's targeting seniors and disabled, where over 266 units is afforded to low-income individuals, all of them Section 8 individuals. And what's beautiful about this is that we don't just invest in property, but we invest in people. So as part of what we look at before we make an investment is what's happening with that affordable housing property. What's going on there? Is there after-school program if it's a young demographic? If it's senior, are they providing opportunities for holistic lifestyle changes? Are they providing exercise where they're nudging them to walk and to have healthier lives? Are they doing other things to help? And you can see here where there are programs incorporated with this particular investment from health, nutrition, mental health, fitness, communities coming together, faith communities coming together and having Bible study. And more than anything else, people need community today. So when we invest in a property, we want to make sure that it's not just a place where people go live, but there are these amenities and these other things affording them to have upward mobilization and have the best life that they can have. And that's the kind of investment we're looking to make an impact in the communities. So I'm going to stop there. And that only really leaves 5 minutes for question and answer. And I apologize, I could talk about this all day, but I'll turn it back over to Angela.
Great. Thanks so much, James. We really appreciate your time and your generosity with it and sharing the good work of CCM. It's really exciting to hear all about what you're doing, and you could talk about it all day and we could listen to it all day, but unfortunately we're getting close on time. So I'm going to turn it over to Brad Masters.
Awesome. Thanks, Angela. And again, to all of you for taking the time to join in. Just quickly, in terms of some next steps, if you're an existing client of the New Covenant Trust Company and you would like to schedule a more formal client review so that we can share how today's information is incorporated into your specific accounts that are in our care, or if you're not currently a client but would like to learn more about how we can serve you, please reach out in one of the following ways. As you can see here on the slide, feel free to reach out directly to the New Covenant Trust Company by phone or through the NCTC website, or also by reaching out directly to your Presbyterian Foundation Ministry Relations Officer. The Foundation's website is listed here for you as well for reference. Beyond that, just to learn more about the Presbyterian Foundation in general, we would strongly encourage you to get to know your Ministry Relations Officer, such as Rose and her team of colleagues, as their focus remains on bringing intentional and specific resources related to stewardship education, plan giving, lots of other services related to fostering healthy and creative ministries throughout the church. But just in closing, just please know that as a collective team, meaning the foundation and the trust company, we are committed to serving each one of you in a broader, more significant, sort of more holistic manner that's consistent with the specific needs, plans, policies, preferences, things that you have for your specific and unique situations. We'll welcome any opportunity to participate in any upcoming meetings, perhaps that you already have scheduled in the coming weeks or months, or we are glad to schedule a time to meet with you at your convenience. But we are grateful for the opportunity to serve and partner with you in ministry. This is very meaningful work for us. So Angela, with that, I'll glad to turn it back to you for a few minutes of Q&A. Thanks, everyone.
Great, thanks, Brad. We really appreciate it. So we do have a couple of questions, and I think I'll start with the second question first. And James, I think both questions are for you. The first question is, how is CCM associated with New Covenant funds? And actually, I think we'll answer that for New Covenant Trust Company, and how to move funds from New Covenant Trust Company to CCM.
Thanks, Angela. And we do have two Jameses. So are you directing that? I'm guessing you're directing that to James Carey. Yeah.
Yes.
Yes.
Sorry.
Yeah. So yes, if you are a client of New Covenant Trust Company and you've elected to be a socially responsible investor, you are already invested in community capital management, and you are already supporting the work and the projects that James Malone outlined. So if you do have a question as to how you can become a client of New Covenant Trust Company or place any investments with New Covenant Trust Company, please, again, as Brad mentioned, reach out to us, reach out to your ministry relations officer, and we'd be happy to do that. But if you have funds with New Covenant Trust Company, it's very easy to participate with CCM, and it's possible you already are if you signed up to be socially responsible.
Great. Second question for James Carey. Is the New Covenant Treasury Obligation Fund a safe haven for moving some funds from balanced growth, balanced income, and growth funds in a volatile market? Is this bond fund set up to provide flexibility to limit bond duration as interest rates begin to rise?
It's a great question. So my understanding of the Treasury Obligations Fund is that is a money market fund. And so the answer to that question would be that, to the extent that you are segmenting any assets out of your balanced growth, balanced income investment strategies or growth strategies, you are taking those funds out of market volatility, both stock market volatility and bond market volatility. A money market's duration is essentially zero. So you have a very, very low duration position in money market. The problem is you don't want everything in money market right now because there's two types of risk. There's risk that the stock market goes down, but there's also risk that inflation takes all of your purchasing power away from your cash. So you don't want everything in cash, but we are encouraging 6 to 12 months. Look at your budget, 6 to 12 months of your spending. If you have a big capital project, a new roof, anything large in the next 12 months, we would encourage having that in a money market cash-like position, such as the Treasury obligations.
Great, thanks, James. And just for further clarification for folks in case they're wondering, so the New Covenant Trust Company is a subsidiary of the Presbyterian Foundation, which is a OCC chartered trust bank, and the New Covenant Funds is a registered mutual fund that is sponsored by the by the Presbyterian Foundation, and the New Covenant Trust Company provides social witness services and also shareholder services for those funds. So they are two distinct entities, and just wanted to provide that moment of clarification. We are right at 2 o'clock. I do want to thank everybody for participating, all of our presenters today. We really appreciate your time and your thoughtfulness. But we also want to thank all of our participants. We really appreciate you spending this time with us today. We are so grateful for the relationships that we have within the Presbyterian Church, and also all the ecumenical relationships that we have and the partnerships that we have. It is such a privilege to be able to serve such an extraordinary constituency, and we count ourselves grateful and give thanks to God daily for you. So again, we really appreciate the relationship that we get to have. And most importantly, we're grateful for your support and for the trust that you place in us. That means more to us than you can imagine. We hope that you have a wonderful day and that you stay safe and healthy in these trying times. So again, thank you so much for your time today. We really appreciate it. Have a wonderful day, everyone.